Hi. Big news out of the White House. President Trump has officially proposed a 50-year mortgage plan. That's right, half a century. And depending on how you look at it, this could be something that either opens the door for a new generation of homeowners or set up long-term risks that the housing market has never seen before. Today, I'm breaking down exactly what this could mean for buyers and sellers right here in Roseville, Rocklin, and Granite Bay. The good, the bad, and the part that nobody else is saying out loud. So why is this happening? Let's be real. Housing affordability is broken. Nationally, the average mortgage payment has jumped 80% in just 4 years, while wages have nowhere near kept pace. Here in Placer County, the median home price sits at around $700,000, and even with solid credit and stable income, that's a hard number to swallow. So President Trump's team is pitching the 50-year mortgage as a bold fix, stretch the term, drop the monthly payment, and give working families a fighting chance at ownership again. Sounds good, right? But when you stretch a loan out that long, you're not just changing the payment, you're changing the entire psychology of homeownership. Benefit number 1, lower monthly payments. Let's take a realistic example. You buy a house at $600,000 with 5% down, leaving $570,000 loan at 6.3% interest. On a 30-year loan, your payment's about $35-31 a month. On a 50-year loan, it drops to around $3,163 a month. That's roughly $360 less per month, or $4,500 a year back into your pocket. And for a lot of people, that's the difference between owning a home or renting forever. Now let's talk cost. A 30-year mortgage equals about $700,000 in total interest. A 50-year mortgage is about $1.34 million in total interest. However, renting at $3,500 a month for 30 years, that's $1.26 million, 100% interest. So yes, you pay more for the 50-year mortgage, but renting costs you everything. Renters pay the same money with no write-offs, no appreciation, no control, and no equity. At least homeowners, even on a longer loan, get a piece of the pie back. The real risks. Let's not sugarcoat it. A 50-year mortgage isn't a miracle cure. First, you pay nearly double in total interest. That's the trade-off. Second, your equity builds painfully slow. After 30 years, a traditional borrower owns their home outright. A 50-year borrower still owes around $410,000. You're paying interest for a much longer stretch, which means you'll need rising property values to stay ahead. Third, you're exposed to market risk. If home prices flatten or drop off early in your loan, it'll take longer to climb back into a positive equity. Finally, it's basically a lifetime debt. If you start this loan in your 30s, you could literally be paying into your 80s. That's not the American dream most people grew up chasing. But most people don't end up paying their 30-year mortgage off anymore either. So here's the twist. Maybe this is the new version of the dream. New psychology of homeownership. Think about how we treat cars today. Few people keep a car until it's paid off. We lease, trade, refinance, and upgrade. Housing might be headed the same way. Most people move every 7 to 10 years, so a 50-year term might not matter if you sell long before it ends. What matters is affordability and access. Can you get into a home and start building wealth sooner rather than never? Because waiting for the perfect time usually just means paying someone else's mortgage. The upsides in equity math. Let's look at what happens when you actually stay in the same home and let time and inflation do its thing. Even with a modest 3% annual appreciation, that $600,000 home grows fast. After 10 years, it's worth about $806,000. After 20 years, roughly $1.085 million. That's nearly $485,000 gained before counting any principal reduction. Now here's where it gets interesting. That gain compounds regardless of your loan term. Even if you're paying slower on the principal, inflation and appreciation still work in your favor. Renters don't get that advantage. They're on the wrong side of the equation, paying 100% interest financing someone else's wealth. So yes, you're paying more interest with a 50-year loan, but you're also locking in an appreciating asset in an inflationary economy. Your payment stays fixed, your income likely grows, and over time, that loan feels lighter and lighter. Think about your parents or your grandparents. What they paid for their first home now looks laughable, but at the same time, it felt expensive. In 2050, people will say the same thing about 2025. What this means for sellers. Now, if you're a seller, listen up. This is where it gets very interesting. If 50-year loans roll out nationally, and it's a stretch that they will, it expands the buyer pool. That means more offers, stronger demand, and potentially higher home prices, especially in desirable areas like Granite Bay and Rocklin's master planned communities. Buyers who were once priced out suddenly re-enter the market, fueling momentum. We've seen it happen before in the early 2000s when creative financing surged. The question is, can we do it responsibly this time? Because yes, more buyers equals more sales, but it also means we have to educate people on how to use this tool wisely. If buyers treat it like a safety net, not a shortcut, it can be powerful. But if they treat it like free money, history will of course repeat itself. So is the 50-year mortgage a game changer or a debt trap? It's both, depending on who uses it. If you're disciplined, see the big picture and use it as leverage to get into a home sooner. It can absolutely work in your favor. If you stretch too far, bank on short-term appreciation, or skip the math, it can bury you. At the end of the day, it comes down to one question. Do you want to pay forever and own nothing, or pay longer and eventually own something? If you're in Roseville, Rocklin, or Granite Bay, and want to break this down for your situation, let's talk. I'm Jayson Flory with Turn the Key Real Estate, helping you navigate this market one smart move at a time.